Welcome back, everyone. Shares of Lyft, we're keeping tabs on those pre-market here this morning. They are on the move following Friday's big loss, and there you're taking a look at that 5-day view. This is after our next guest lowered his rating and nearly slashed his price target in half for the ride-sharing company due to longer wait times and rising competition. For more on the road ahead for ride sharers, let's welcome in Brad Erickson, RBC Capital Markets equity analyst of Internet. Okay, so Brad, walk us through the thesis here with Lyft and what really led to this downgrade in terms of the broader ride-sharing market and what you're seeing.
Yeah, thanks. Nice to be here. So, I think it was a couple of things. We do a sort of quarterly tracker where we use 400 rides across the 10 largest cities in the country to try and get a sense both directionally how both companies are doing, so effectively the ride-hailing industry as a whole in the U.S. And then we also look at it, obviously, Uber versus Lyft on a relative basis. And I think with this analysis, what sort of changed was that we found a couple of things. One, the industry overall saw a little bit of an uptick in terms of time to pick up, which is how we gauge how well supply is doing versus demand. I think magnitude-wise, Uber wasn't so concerning, but I think Lyft's increase being more than 20 points higher than Uber was sort of the concern. And then secondarily, I think Lyft's pretty exposed to the West Coast, which for those who aren't aware has been obviously lagging in terms of coming back to work and showing more normal behaviors post-COVID. And with a fifth of the business, we think being in LA, San Francisco, Portland, Seattle, places like those, we look at LA as a pretty hard proxy for how Lyft's doing. And there, Uber massively outperformed, I would say, in terms of wait times relative to Lyft. And so finally, to us, it kind of suggests that there may be something bigger, more structural in nature going on in terms of Uber being able to acquire that driver supply. And as a result, kind of forces us in the position of having to change our rating, which is obviously what we did.
Brad, is there also something, is there validation behind Uber being more of the super app at this point? And Lyft has made it very clear they're just going to focus on transportation.
More so than just the super app at this point, I think just the platform approach, right? Delivery of all things, grocery, retail, and restaurant, as well as the ride-hailing aspect. And so I think, obviously delivery benefited tremendously during COVID. And we think that obviously helped lubricate bringing drivers onto the platform on the ride-hailing side. For Lyft, certainly things have been challenging at times over the last year. Used car pricing, women don't tend to want to do ride hailing as much as men because of safety factors. They'll be more apt to doing delivery. So factors like that have impeded ride hailing demand. And that's, I think, to the point of yes, Uber having sort of more of a structural advantage from a platform perspective.
Hey, Brad, it's Julie here. When it comes to what you were talking about in terms of wait times, in terms of the actual rates that people are paying, can you explain the discrepancy to us a little bit? I mean, I don't know what percentage of drivers have both. Certainly, anecdotally, it seems like a lot of folks do. But I wonder why it is that there would be such a significant gap in wait times between the two services.
Yeah, we've historically found it always varies a little bit. Usually the magnitudes are somewhere between 5 and 15% in terms of the number of minutes someone would have to wait. Historically, we've actually found Lyft frequently, basically in 90% of our samples. We've been doing this since both companies went public. Frequently, Lyft is the faster vendor, and this time around Uber was the fastest vendor. We've only captured that one time in the 3 or so years that the companies have been public. So there's always going to be minor discrepancies, and of course, we get beaten up a little bit for having small sample sizes. But I think historically, when we've run this analysis, certainly over the last few quarters, we found it to be instructive of trends that ultimately the companies talk about, like driver incentive shortages, which we called out back in March in the same analysis, and then the companies, Lyft in particular, called it out on the May conference call when they reported Q1 earnings. So,
Brad, it's interesting right now as we continue to tee up another earnings season. We're going to hear a lot about companies who are battling macroeconomic conditions, everything from war in Ukraine all the way to wages as well, and especially on the wage front, given how so many drivers are classified for Lyft, for Uber, for the ride-sharing companies. How much of that, is it clear how much of that is actually being passed through to consumers, and how much of that we're seeing in our price increases?
Yeah, I think anecdotally for all of us who may have taken an Uber or a Lyft over the last month or two, or 6 months for that matter, prices have obviously seemed very elevated. And, I think that was a combination of demand coming back on the margin more strongly, and then obviously the company's still playing catch up on a driver supply basis. I think over time, as driver supply ticks up, and we do expect it to get better for the industry overall, to be clear, you will actually start to see prices come down. And effectively what that means is it's drivers achieving better utilization. So effectively driving more minutes within, say, a given hour. And so what's nice about that is actually the companies can allow price to come down, and that's not necessarily a negative thing financially for the companies.
Brad, before we let you go, you also cover some of these social media companies, Meta, Snap, and also Pins. Which company are you most concerned about going into this earnings season?
That's a very challenging question. I think overall, certainly there has to be a lot of skepticism around the advertising industry with macro concerns and supply chain concerns and costs in many cases, as well as rising wages. That those three factors can obviously cut into small and medium-sized business confidence in particular, and ad spend is an easy place to start making cuts. So industry-wise, I would expect commentary from all of the advertising players, social media and otherwise, in the internet space to be relatively challenged. I think Snap in particular to us stands out as one where, given the inconsistent results over the last several quarters, the multiple is severely depressed, and I think you can make the argument that street estimates are probably a bit conservative. But I think there we continue to view that one as being sort of at the end of the spectrum, most discretionary. And so in the event of further volatility, the most at risk of seeing potentially concentrated and material advertising cuts.
Good analysis here to kick off the week. Brad Erickson, RBC Capital Markets analyst. Good to see you. We'll talk to you soon.